The U.S. car market is seeing a massive downturn, and used car prices have taken their steepest month-to-month tumble ever due to a flood of available cars and vanishing demand. Car sales are taking a nosedive. Famous auto brands are slashing prices, even beyond $10,000. On the other side, loan agencies are anxious as countless consumers owe more on their car loans than the vehicle's current value. Things are in turmoil, with alarming future implications. From 2020 to 2022, pre-owned car prices jumped nearly 70%. Although they've tapered off since December, more drops are expected. After witnessing soaring prices for used cars, America is now gearing up for a potential 50 to 60% price descent from the current rates. This looming price slump is predicted to be major, putting several vehicle owners in distress. Industry experts are skeptical about prices returning to their old norms. In the past years, the spike in used car values was largely due to a global semiconductor chip crunch. With the onset of the pandemic, chip makers cut down their production. Yet when global needs surged faster than projected, numerous individuals, buoyed by government relief funds, bought new cars, amplifying the chip scarcity. With only a few global chip producers, meeting this high demand became a challenge. Goldman Sachs points out that modern cars now need about 298 chips on average, which is 40% more than cars before the pandemic. As car makers couldn't get enough chips, new car production slowed, leading to a surge in used car values. We're now seeing this trend start to reverse. Chip makers have ramped up production to fulfill increasing demands. Disruptions in the supply chain due to the pandemic are lessening, and auto producers are emphasizing the creation of new cars to mitigate the shortfall. While this usually signals a positive shift, the current landscape is clouded by rising interest rates, making financing pricier. Hence, car demand is nosediving, with predictions showing severe price drops across all car types. Some might even lose over half their value, as KPMG experts suggest. Their analysis forecasts that about $1 trillion worth of both new and used cars might vanish from the market during this downturn. Just like any economic bubble, what ascends must eventually descend. This used car price bubble burst suggests numerous car owners will soon find their loan balances exceeding their car's worth. In essence, those now overpaying for used vehicles might soon be stuck with loans that surpass their car's value. The recent Manheim Used Vehicle Value Index update showcased a jaw-dropping 15% monthly decrease in wholesale car prices, indicating the most significant year-over-year decline in its 26 years of tracking. The market's roller coaster over the past 3 years has been marked by alternating slumps and record-breaking hikes. By December 2021, there was a remarkable 70% annual growth. A return to the pre-pandemic status quo seems increasingly distant. Rebalancing supply and demand might take multiple years. Jerry, a prominent car insurance comparison site, recently released a study pointing to a bleak outlook for the U.S. car sector, hinting at an extended path to revival. Historically, the used car market has been bolstered by vehicles coming off leases. However, this trend has seen a sharp decrease recently. In 2020, 2.4 million leased vehicles entered the used car market. This figure dramatically dropped to 1.2 million in 2021 and only 400,000 in 2022. Generally, at the end of leases, people return their vehicles. But given the unexpected rise in used car prices and favorable preset purchase options, many opted to keep their leased vehicles instead. The research also indicates that the stabilization of the used car market to pre-pandemic levels remains a distant goal. In 2019, there were 13.1 million used cars up for grabs, which decreased to 11.6 million in 2020, and took a deeper dive to 9.5 million in 2022. Worryingly, this year's projection predicts only about 9 million used cars on the market. It seems the market won't find balance in its inventory until around 2025. The broader economic environment is another crucial factor set to influence the automotive market, and its trajectory remains uncertain. There are looming predictions of a significant economic downturn in the upcoming months, which will undoubtedly shake the market. Close monitoring of this situation is essential. In the same vein, Sam Fiorane from Auto Forecast Solutions points out the economic downturn's potential effects on consumer spending. especially on substantial investments such as new vehicles. The year started with grim figures for car sales, showing an 8% dip, the lowest since 2011, a time when the economy was recovering from the profound recession. Last year, vehicle sales, including cars, trucks, SUVs, and vans, totaled 13.9 million, a decline from the usual benchmark of 17 million. Market experts predict a further contraction of around 1 million sales in the coming months, signaling the severe repercussions of reduced demand. Specific car models are experiencing sharp declines in their prices. For instance, the Ford Mustang, which was priced at $31,495, dropped to $26,852 just last month. Meanwhile, the Toyota Ray V4 over the past year saw its price fall from $31,766 to $28,283. Notably, even the electric vehicle segment hasn't been spared from this downturn, debunking any myths of its invulnerability to market shifts. Tesla serves as a prominent example. CEO Elon Musk has resorted to cutting car prices by as much as 20%, aiming to boost sales amidst flagging demand. This strategy means that many Tesla owners will face significant depreciations in the values of their vehicles, mirroring the slide in the prices of new models. Those who have recently acquired a Tesla will soon feel the sting of this and may regret not leasing their vehicle. The immediate slashing of prices on new vehicles is bound to have a ripple effect on the used car segment, likely pushing their values even lower. It's not uncommon for car buyers to find out about a rebate just days after their purchase, realizing they could have saved significantly. But the current situation is different. While dealer discounts are usually short-lived sales, the ongoing price cuts dwarf regular rebates. This is particularly pertinent given that 80 to 90% of new car purchasers and about 60% of used car buyers depend on loans to fund their acquisitions, whether they're secured from dealers, banks, or credit unions. The intersection of rising interest rates, inflating prices, and hampered affordability prompts the urgent question: will a large portion of those who financed vehicles at heightened prices soon face mass loan defaults? The horizon ahead seems unsettling. While initially overpaying for a used car may seem like an individual setback, it morphs into a broader concern for financial institutions when this scenario impacts millions. Ally forecasts its charge-offs to increase to just 1.6% next year. Considering the declining collateral value, such an outlook seems overly sanguine, notes Kane. Instead of pointing fingers at banks and lenders for sanctioning loans anchored primarily on bloated car values, regulators are zooming in on the consumer's credit profile. Economically speaking, the challenges in the used car sector appear to reflect a more expansive concern. This concern hinges on consumers leaning heavily on stimulus packages, extended credit durations, and diminished interest rates, rather than their actual income potential, as Kane elucidates. Even Cathie Wood, the head of ARK Invest, voices grave concerns about the U.S. auto sector, urging prudence for both car producers and financiers in the face of waning consumer interest. Granted, auto financiers do act judiciously. They demand upfront payments, adjust interest rates according to creditworthiness, and hold the right to reclaim vehicles if customers falter in their repayment commitments. Traditionally, cars have been considered dependable collateral. The emerging issue, however, is the drastic fluctuation in collateral value. Loans were given out based on elevated car prices, and now with these values taking a nosedive, lenders might face unparalleled losses. Kane further probes, how extensively have these loans been securitized by Wall Street and then marketed to investors as rock solid? The actual stability of the collateral is now in serious doubt. Elon Musk's warning resonates louder given this backdrop. He speculates that the unfolding situation might lead to the most profound financial meltdown ever recorded. The debt exposure significantly outstrips what lenders are prepared to admit. As we witness banks faltering, the systemic risk from the car price bubble becomes palpably clear, Musk comments. The unfolding scenario bears eerie similarities to the 2008 financial crisis, with looming automaker insolvencies and potential bank collapses that might have catastrophic implications. Thank you so much for tuning in. Catch you in the next video.